Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts. We are moving right along into the new year already. This is our February podcast we're getting started on, and so January was a rough month, and markets weren't so happy in the month of January, and so it's been one of those things. We're going to talk a little bit today about having money biases, and obviously the market can affect that a little bit, and maybe what it could be costing you. We got an interesting take from an article here we're going to get into. Phil, what's going on, buddy? How you doing?
Doing good.
Yeah.
Looking forward to February, getting closer to the spring. So
yeah.
Although, we've got a major storm coming in this week, so we'll see. Yeah, they're saying biggest one in 7 years. So
why? Well, this seems fitting then, right?
That's right.
January was not a good month.
No, not in the markets, that's for sure.
Well, it seems like all over, right? Everybody's been sick. Everybody it seems like is sick. There's been some extra bug going around on top of everything else. The markets definitely wound up closing out with the worst month, Phil, since March of 2020.
Yeah, that's what I saw.
Yeah, so not
worst January 2020. Right? So
yeah,
yep, absolutely. Where's it going from here? So
there's no reason necessarily to panic yet. We're early in the year, but something to certainly think about. It's been 12 years. Right.
Yeah.
So without a prolonged downturn, so we are certainly more than due. So on this episode, we're going to break down this article that kind of talks a little bit about a Morningstar study. And Morningstar, Phil, if you want to let folks know what Morningstar is, it's a pretty reputable.
They're an analytics firm that they've both on the data side, like in this case, dealing with non-financial information.
Right.
The human side of it, but also more the financials. So doing a lot of analytics on mutual funds, ETFs, and different investments. So
okay, so we're going to look at some of the key points and the takeaways here from this study. That's where it could be costing you possibly some money when it comes to your different types of accounts, and so maybe you want to listen in or kind of watch and see if this might impact you specifically, and see how your biases are to try to get some of that back under control. So a couple of key points real fast is basically everyone has different attitudes about money. No groundbreaking assertions there, right?
Yep.
We all know that. But this new financial study from Morningstar found that 98% of respondents exhibited one or more of the financial biases that are costing them money. So we're going to break down those with these key takeaways, Phil, understanding the four main biases. So why don't you kind of run through them? What are some of the main biases here?
First one's going to be what they call present bias. It's a tendency to kind of look at the here and now, right? I mean, we're in this now generation. Now, I mean, everything happens so quick. You get it on your phone now, the microwave, drive, everything's, how quick can I get it?
Yeah, the instant gratification world.
Yeah, it's we kind of lose sight sometimes of the long term.
Okay,
and that's a huge potential money bias in many fashions. I mean, just in savings. I mean, that's probably the biggest one is, looking beyond today of, okay, what does this look like down the road, for retirement? I mean,
we're foregoing the long term, we're not looking at the longer projections. We're just give it to me now.
Yeah, look at what's going on right now.
Okay.
So you've got to have that longer term perspective from a financial planning standpoint. But even looking at the markets and everything else, something that's similar to this, the recency bias. I mean, we have a tendency to look at what's going on right now and kind of forget the past.
You've got the base rate neglect, basically, which is, I guess, judging that probability of something happening based on new information.
Right. Yeah. Okay. So again, kind of just looking at new information, not looking at the reality. Similar to what we're talking about of, markets don't always bounce back as quick as they have, for instance, right now, looking at the current, that more recency type bias of, this is the way it happens, forgetting some of the core principles of, investing or markets in general, I mentioned it. Yeah. The reversion to the mean. I mean, if you look at an average return in the market, I always tell my clients, look, if the market's averaged 8% over, a long historical period of time, any point in time you're earning more than 8, you're getting too much. You're going to give it back.
Well, and that probably leads to this third one, which was overconfidence, right? Which is, and we've seen 12 years worth of overconfidence building.
Yeah. Yeah. And overconfidence here is both that, in the markets, but then even in yourself. I mean,
True. Yeah.
it's been easy being an investor in the last 12 years. Right.
Very
I
true.
mean, hey, the markets are going up. It's always easy investing when the markets are going up,
Yeah.
because pick an index,
Right.
you're good.
Exactly.
How
Well,
hard is
I think,
this? Come on.
I don't know if it's totally official or if I've got the numbers wrong either way. But 21, I think finished off at what, 26% up, I think
Something
overall.
crazy. Yeah.
Something where, so, and then the year before that in 20, which it was down, but it was actually up, right?
Right.
20 was up. So 19 was up. So there's been 3 straight years of really high, well over 15% every year.
Oh yeah.
Yeah. So it's easy to kind of build that overconfidence, to your point.
Right.
Everybody, you're picking pretty well each time. Right. So
Right.
that's that one. And then you've got another one here, takeaway number 4 on this first bit. The bias is the loss aversion. And that's people who overly are fearful of losing the money relative to the gain. So explain that a little bit.
Right. And we talked a little bit about that. I mean, a lot of times people are on one side of that equation or the other. Loss aversion, they're too afraid of losing money. So they're going to be really conservative, and then a lot of times this happens to individuals retiring. You think, okay, now I'm in retirement. I don't have this longer time horizon.
Kind of get that paralysis.
So I've got to make sure I keep my money safe. Right. So it's going to go in the bank or something really safe. And the challenge there is the flip side of the coin of inflation, right? And, up until this year, it might have worked, because inflation was relatively low. You could probably take a more conservative stance with that kind of inflation and been okay. But as inflation starts to bounce back and we come back to more of a normal state, and inflation rises, that's just what it does. Ebbs and flows like the markets, like interest rates. We go through these ups and then downs. It goes back and forth. So you have to have investments that'll keep up with that, So I mean, that's the biggest concern there is not taking enough risk. You have to have risk to keep up with inflation.
Right. Got to, especially today's inflation, right? So we're definitely dealing with a lot more. So, okay, so that's kind of the main takeaway. So let's go to takeaway number 2, Phil. Low levels of money bias equals better financial health. What's that kind of mean to you?
Yeah, well, I mean, it's just looking at the biases and recognizing them, and if you don't have these biases, if you're, I don't want to say level-headed, but if you're approaching it more of a, not having one of these biases one way or another, over the long run, you're going to have better financial decisions, a better health. So if you're not so loss aversion, you're don't have that fear of losing money as much, understanding that that's part of investing.
Right.
And then understanding how to position it so that it doesn't harm you, you're going to have a long-term better result. And you're going to be more comfortable in retirement in that process too, because knowing that, hey, it's going to happen. I can't prevent it.
Yeah.
But I need to have risk, and this is how we're going to position it. I'm okay.
Well, in the study, they put the research revealed that people who had low levels of present bias were 3 times as likely to spend less than their income. They were 7 times more likely to plan ahead. That sounds like a good thing, right?
Yeah. And I mean, really, it comes down to planning, versus oftentimes these biases lead into reaction, right? It's everything you do is based on a reaction. Okay. You're reacting to what's going on versus if you've run the numbers, you've got a plan. Yeah. These things are going to happen. We know markets are going to be volatile. We know we're going to have inflation. We're going to, all these different things aren't new. This is not a surprise. It happens.
True. Right.
So you need to understand that. And if you have that longer term perspective built into a plan, understanding, hey, we've talked about this, and if this happens, this is how we're going to handle it. You have that long-term goal, or long-term perspective, you're going to be better off in the end. Well, we're not losing sight of what's going on today, but you've got to, understand today through the lens of the long term.
Well, to the point that we just made of the market being so volatile in January, a lot of conversations I've been having with advisors is, are you getting a lot of phone calls, right? When it gets really volatile, people tend to get nervous. Well, if your biases are not there, if you're not as stressed out by these things, you're in better financial health.
Yes.
Most advisors are saying, no, because they work with me or they work with our firm, they've got a good plan. They're not necessarily reacting to the news. You have a few people occasionally, right?
Sure.
But they're not
Absolutely.
necessarily overreacting to the news. They might say, hey, do we need to make any adjustments, or have you already preemptively done that? And a lot of times, Phil, that's what you've already done. The plan is taking into account ebbs and
Correct.
flows.
Yeah, and we've already, the same point I have with my clients. I don't get that many calls in markets like this, or as even when we went through the pandemic time frame, where it was steeper and quicker,
right?
Because it's something we've talked about. Not that it was going to happen that quick, but hey, we know it's going to happen.
Right.
We're going to lose money.
Yeah,
markets are going to go down. Where is that position? How are we hedging against it?
And it's your later money too. You're right.
And it's later. Exactly. Yeah. We're not touching that money for 10 or more years. So the way at least we structure it, we've got time on our side for that money. And that really helps clients avoid some of these biases of, I understand the markets are down and that's going to affect me some, but it's over here. My income that I'm getting today is coming from here, and that's not doing that. So I'm okay.
It's when you sell it and lock in those losses.
That's when you have all the harm.
So takeaway number 3 here, it says solution, build a money life that fits your priorities. So Morningstar's authors call in for putting speed bumps in to place slow decision-making processes in front of it, kind of like barriers, if you will, I suppose, so that you're not making these overly emotional reactions. And some of this could be preemptive to say, hey, we may see a really rough year in 22 from a financial standpoint in the markets. Are you going to be able to keep your emotions in check to make those decisions soundly? And that's huge value, I think, in working with an advisor like yourself, because that's what you do. You're like,
and I mean,
hey,
at the end of the day, that's the important part of understanding biases is the biases are really affected with emotion, right? I mean, that's really what drives these biases is emotion. And if you're acting on that emotion, 9 times out of 10, decisions made emotionally quickly are not going to be a good decision.
Anybody who's lived,
it just doesn't happen. Because that fight or flight, the panic, we're acting at the wrong time with very narrow information and what we think is happening today, not this bigger long-term picture. At the end of the day, most of the times, if you a year, 2 years down the road get to look back, and you would have said, I probably should have done something, or would have done something different. It's easier for us, granted, it's not our money.
It's not your money, right? Yep.
But at the end of the day, I mean, to me personally, I still feel like I've got skin in the game with my clients. I feel responsible. I mean, they've trusted me to help them through retirement. So I'm not going to give them what I would, wrong advice, something that I wouldn't do. But, and that's our goal, to your point, is to help clients map it out, do the financials and, the investing, but also then help them walk through these emotional decisions that they have to make. And I always tell my clients, look, give me a call. Please talk to me first before you just do something. Let's talk it through. At the end of the day, it's not my money, it's yours. You can do whatever you want.
Yeah, you're not asking.
I'm not going to stop you. I'm not, between you and your money. You don't have to ask me permission. It's yours.
Right.
But I'd rather, if you want, here's my insight and this is what I think. It's up to you. Do what you want.
Well, so many of us do kind of get into that thing where we go through many stages of life where we're like, well, we adopt that it's better to ask forgiveness than permission kind of mentality. But, when you're working with an advisor, if you call them up and bounce something off of them and they don't agree with your idea, let's say I called you up, Phil, and said, hey, I want to, make this move to this. I heard this company's going to blah, blah, blah. Mm-hmm. And you tell me you don't think it's a good idea based on my plan. Ultimately, it doesn't mean that, you've said no and I can't do it. It's my choice. But I've asked you for your feedback and kind of to some points that they made with this in order to kind of build some emotional, speed bumps in there. Maybe wait 3 days before making a financial decision. Something comes up, something presents itself. If it's good today, will it still be good in 3 days? That's a simple way to do that. To your point, reach out to your advisor. Bounce it off of them. That's another way. You could also set some rules that says like selling stocks after a 10% gain. How do you feel about that? Like you've made 10% in this. Should we maybe, scale it back?
Yeah. And again, it's easy to get greedy, right? When things are going good, we want more of what's working.
Sure.
But again, having some rules around that to say, well, would you put everything in one investment because that's done really well,
Right. Probably
maybe
not.
this year,
Hopefully
yes,
not.
it's done
Right.
really well this year, but how is it done over the long term?
Right.
You know, that's why asset allocation and having different investment strategies in a portfolio work, right? They complement each other in different years and react differently. You know, so again,
Right.
that's
Yeah.
where this comes into play. Yeah, having some kind of rule around that and
Not a bad idea.
yeah, not a bad idea at all. You know,
No.
it's like going to the casino, right? I mean, you feel good
True.
when you're winning.
Yeah.
Oh, let's throw some more
Yeah.
in there, but you know, at some point you're going to lose. So
Yeah, if you're riding
having
up the
some
Soaring
rules
Eagle,
around to say, here's what I've got. This is what I'm going to spend.
Yeah. Yeah.
So,
Yeah. If you're going up to Mount Pleasant or Soaring Eagle or whatever, just have some rules in place. Okay. So basically at the end of the day, looking inward, which money biases do you see present among your clients? Is there anything that in general sticks out with you? Maybe not necessarily your clients, but maybe just the public at large, right? When someone's reaching out to you for help, what are some of those things that initially kind of, present themselves among today's retirees?
I mean, retirees, a lot of times the loss aversion is a big one. I run into that, I think, more than those that are still wanting to, take a higher level of risk.
Okay.
Because granted, this is what they have. I mean,
Yeah.
right. I've worked and saved, and this is the money I have to live on the rest of my life. So I can't afford to lose it.
Yeah.
But there's other ways to lose it versus the market. So you've got to understand both sides of it. So
we're in protection mode usually.
Yep. Which, I mean, there's nothing wrong with that with a portion of the money, but there's other risks you have to protect against. The market's one aspect, so, and then the other big one is going to be that recency bias, just not looking at the bigger picture, focusing more on what's going on right now and making decisions just on that versus running that decision through this long-term lens of, okay, does it fit my plan long-term? How does it fit in? So those are probably the two biggest biases I would say I see just in general. And that's where I can help clients with those is, constructing a plan and then walking through that process so that you're never going to take the bias away. It is what it is. But then
it's part of your DNA usually.
Recognize it. Right. They're usually, if you get back to the end of the day, when somebody has a bias, there's a reason for it. It's an experience that they've had.
Yeah. Can you identify the fact that you have some biases? And then if you do, then what do you do to maybe, offset those? The lower you can keep those biases, typically the study has found the better your financial health. And if you do have them, putting in some speed bumps, circuit breakers, if you want to use the stock market term, right? They've got those circuit breakers when things got really crazy back in the pandemic free fall, those breakers kick in to stop it from going too far, right?
Right.
Same kind of idea.
Everyone take a halt, kind of step back for a second, let the emotions settle a little bit so you can make a more clear-minded decision. Yeah. So,
Yep. And typically, and the Morningstar has I've often found in a lot of their studies that, working with an advisor, there is definitely value. The value that you get is certainly worth the fees that you typically pay, depending on the person you're working with. Obviously, it's all part of making sure that you're finding the right one for you. But traditionally, you find that they does bring that extra value to the table because of that experience and that decision-making process when times are tougher. And that's been the tough spot of the last 12 years, Phil, is that to your point,
times have been really good, so people
good, but as it maybe we creep into this territory of this crazy inflation we're dealing with and all the problems that the world's got going on, something is possibly on the horizon, and we have a prolonged downturn. It's got to be there soon. And that's when people get nervous. That's when people make mistakes. And that's when they lock in those mistakes. So definitely make sure that you're talking with an advisor, having a conversation, see if you can identify your money biases. We'll put a link to the article in the show notes. So if you want to check that out as well, that way you can kind of dig a little deeper if you'd like to. But if you've got questions or you've got biases, reach out to Phil. As he said, call me, bounce something off of me. Let's talk about it before you make that decision. And you can reach out to him at 248-888-7530. That's 248-888-7530. If you're watching on YouTube, it's on the screen. philstaxhacks.com. We've got the video placed there as well. So whether you're listening to it in audio form or video form, definitely do yourself a favor. Reach out to a financial professional like Phil before you take any action. He is a CPA and a personal financial specialist. Phil, thanks for hanging out with me and talking about this biases. So I guess, do you have any of your own?
I mean, probably the overconfidence, as a financial advisor, it's easy to think, I know I've got this. And, mine probably is not risk aversion, but
That's
it is
fair.
what it is. I'm still younger, so I mean, I've got time to. I'm on a different horizon than most of the clients I deal with, and that's a big piece of it is understanding where you're at,
time horizon,
how they can affect you. So,
and often we see two different types in a relationship, right? So you're probably one way, your wife's probably another.
Absolutely, and that's the interesting part to me always is working with that couple and helping them see that, because a lot of times it hasn't come up to this point. One of them is the predominant financial person, but as they get to this point of retirement, oftentimes the other spouse comes in and is more involved in it because now they're concerned. Hey, you're not going to work anymore. Where's this monthly money coming from? I want to make sure this is going to work.
What are we doing? Yeah, exactly. So not only your own bias, but also the bias within inside the family dynamic. So that's going to do it for us this week. Don't forget to reach out to Phil if you got some questions. As I said, I gave out the information. You can find it in the show notes as well. And we'll see you next time on Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.